if cap rates rise and we're in a closed-ended fund, that might hurt our exit. In this fund, we can continue to buy. So in turn with that, the 721 exchange, we can offer units in our fund and absorb a property. And then that owner, their equity becomes, part of that fund. Right. So, then that's tax deferred until they want to exit. And then once they exit, the regular, capital gains taxes will apply to them. But if they request, to cash out at any point, that portion that they cash out is going to be, taxed as a regular exit on real estate.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Keith Nelson has a diverse professional background. He has the experience needed to adjust and overcome obstacles and challenges that he is confronted with in the investment real estate industry. Keith, welcome to the show.
Hey, thanks for having me.
Hey, man, the pleasure's mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Well, if you want the full story, it's going to take longer than 90 seconds. But I started in a car with my partner. We both worked for the federal government. We were on surveillance. So that's where this whole concept started. How we got here, we started with syndication, real estate syndication. We've exited about 25 deals. And we're currently on our second and hopefully final real estate fund.
Second and final real estate fund, exited 25 deals. What asset class?
We started in multifamily, but we have experience in pretty much every asset class right now. So multifamily, storage, office, hotel, even land development lots. I mean, we've done it all.
Right. Is there anything right now that you guys are particularly focusing on?
Strong focus on finding some industrial assets. With the latest bills passed about bringing manufacturing back home. I'm from the Southeast, so there's a lot of projects. I think they plan like 5 million square feet of industrial development. So we're focused on that right now, but it's not to say we wouldn't take on any deal that had the right opportunity.
How have you found an effective way to scale, being so broadly focused? How have you done that? And because obviously you guys have found a way to meaningfully scale into a lot of different asset classes. I guess if I can find the right question, how have you found a meaningful way to scale into so many different asset classes without experiencing, I guess, dilution with your focus?
Yeah, so great question. Like I said, we started in multifamily. That industry got real tight. And we pivoted over to self-storage. That industry's gotten real tight, real compressed cap rates. Really, we tested this model out on our first fund, which was a closed-end blind pool fund. And we started with multifamily. Then we went to Class A office. We had a boutique hotel and some other types. We had self-storage. We had some land lots. And through COVID, we actually proved that concept because we saw our multifamily, which we thought was a very strong asset. All the moratoriums they put on, people weren't paying rent, so that stopped cash flowing. But our other assets, sometimes it's the one that we didn't think would perform that great, such as a boutique hotel, we're carrying the cash flow of our fund. So throughout COVID, we didn't miss a distribution. So we had since exited that, but that kind of proved the concept, and we wanted to move that over to a more open-ended fund. Which we started now.
Got it. And so the first fund you guys did was, you called it a closed-end blind pool fund. How does that differ? You said, and right now you've got an open-end blind pool fund. Is that right?
Yeah. So closed-end means we raise capital for a certain amount of time, and then we have X amount of time to deploy that capital. But then once it's deployed, that's it. There's no more raising. We have a set horizon on the fund. So we closed it out after 5 years, and it was successful. Everyone made their 20% IRR, and they went home. But we feel like if we were able to continue to reinvest and compound those investments, we feel like we could have blown that up. So we were going to launch our second fund right before COVID, and no one wanted to lock up capital then, because no one, everyone thought the world was going to end, as did I. I didn't want to lock up my own capital. So we went to more of a debt structure. We did that for about a year and a half, and we gave the people option of, hey, look, you don't like, what we're investing in, you can take your money. So that's what we structured our this other fund around. We're more structured like a REIT than a private equity fund, but we are open ended. It is private equity, and people have the ability to come, in and out. So I tell people all the time, like, look, if we start buying stuff that you don't agree with, then request your capital out. We plan form, and we plan to for that not to happen, of course, but that was the benefits that we like to offer.
Got it. Can you quickly break down for us the difference between the closed-end fund and the open-end fund? I mean, obviously, there's the open and then it closes, but I guess strategically, what benefits you, and what are some I guess things to consider on whether you pick one or the other?
Yeah, so like I said, the compounding returns, right? So if we sell an asset in the open-ended fund, we could go redeploy that capital, right? So if there's a margin that we made on that asset, we go redeploy it, put leverage it, put debt on it, and then the returns will hopefully go up for all the investors, as will the unit price of the units they own. So instead of one cash out at the end of the term, we leave it up to the investor where, okay, well, if we reevaluate the share price after certain raises that we have, right? So we plan to do it yearly, but we're not at that. We just launched it this year, so we're not at that point yet. But let's say every 12 months, if there's a 10% uptick in the unit price, plus our quarterly cash distributions, someone wants to continue to stay in it and see what we can do. But to answer your question, it's the compounding effect of reinvesting capital after we exit a property.
Is there again, this is kind of a newer I haven't talked to a lot of people about this concept. I've never done a fund myself, so my questions are going to kind of be somewhat from an ignorant point of view. But is there, so on an annual basis, you guys reevaluate the share price, I guess, of the fund? So every 12 months you say, okay, well, last year it was worth $10, this year it's worth $12 a share, whatever it is. I'm just making it up. Is there a potential that you could ever have a run on the fund?
The run is with withdrawals?
Yeah.
Sure. Yeah. But it is a private equity fund. We're not a publicly traded REIT or anything. So, we specify that if we have the liquidity available, you could exit the money. But, I tell investors all the time, like, hey, this is not an oh crap scenario where World War III breaks out and everyone wants to take their capital out. It doesn't work like that, because there's not going to be the capital there, right? It's just a benefit we like to offer investors where, if someone's got money invested and they want to, I don't know, buy a lake house or a Porsche or something, they have the ability to take it out. It's not locked up for X amount of time.
Right, but you guys still retain the ultimate yes or no authority on that. You can say, hey, look, you can't withdraw right now because there's just the liquidity's not there. Is that right?
It's actually written in there. If it is there, then we're required to. But if it's not there, then yeah, no, we can't. We're not going to dilute, sell off assets to cash somebody out, because that could hurt the overall plan of the fund. So if the liquidity is there, we are required to meet that.
Are there any reporting requirements that are different in an open-end fund versus a closed-end fund?
No. I mean, the only other, I guess, requirement is we do use a third-party service to evaluate the unit price or the asset values, and then it's just simple math to calculate the unit price. But other than that, no. There's, like I said, we're still private equity, so we still, it's still a Reg D filing. It's not a REIT. With the REIT comes extra reporting and all that. So we are still private equity. It's just structured similarly to a REIT.
Well, at what point in a dollar amount, I guess, or maybe this is the wrong question to ask, but maybe it's the only way I can think about it, but assets under management, at what point in that process does it make sense to move to an open-end fund? Is there like, hey, you need to have 100 million, there needs to be, 2 billion, whatever it is, like what's the number for you where you figured out that it makes sense to move to this model?
No, like I said, we just launched this year, so we're fairly new. There's no minimum dollar amount. There is a minimum. I mean, it does make sense if you're moving this structure to a private or public REIT, which we are set up to do on our docs, but we'd have to be over 100 million AUM to even consider that, just because there are so many other extra expenses with running a REIT versus a private equity fund. But now, similarly, it's really not that much different than a typical fund or a typical syndication.
Got it. No, that's really cool. Thanks for taking the time to kind of break down some of the nuances of that for our listeners. I know that's going to be an interesting topic and something that we don't get to talk about a lot. So appreciate you kind of sharing your thoughts on that. One other thing that we had talked about that you guys have as an option in this fund is something about a 721 exchange. I think you had mentioned to me before we kicked this off. What is that?
Sure. So, I mean, I guess to back up, which goes along with the 721, another benefit of us having this open-ended fund is we're able to buy and sell through all the market cycles, right? So, if cap rates rise and we're in a closed-ended fund, that might hurt our exit. In this fund, we can continue to buy. So in turn with that, the 721 exchange, we can offer units in our fund and absorb a property, and then that owner, their equity becomes, part of that fund, right? So, then that's tax deferred until they want to exit. And then once they exit, the regular, capital gains taxes will apply to them. But if they request, to cash out at any point, that portion that they cash out is going to be, taxed as a regular exit on real estate.
So let me get this right. You've got a seller that wants to sell a property, and they can sell that property into your fund, essentially tax free on that initial sale. Is that right?
They could exchange it, right? Yeah, it's not a sale. So we absorb their interest in their LLC. Sometimes we'd have to, bring capital to pay off their loan or, cash out a partner or something like that. But then if they're interested, they become an equity part of, an LP interest into our fund. So that coupled with the open-endedness, gives us the ability to just keep churning and compounding the returns. And, it's so far it's working out pretty well.
And so from a tax deferral standpoint, that's beneficial to the seller. That is
correct. Yes.
Right. Okay.
So those people that are not fans of 1031, it's perfect for them.
Right.
Which I'm not a fan of 1031. So, I found this code a couple of years back and figured out how to work it into our private equity fund. And, so far it's we've done a couple 721 exchanges, but like I said, we're just kind of getting our wheels rolling here.
Yeah, no, that's really cool. That's something until today I've never even heard of. So that's really cool. How do you have that conversation with the seller? Is that something you guys go to? I mean, is it every seller you say, hey, we have the potential to 721 exchange this?
Generally we'll want to buy that asset regardless. So we'd probably lock it up under, a regular cash purchase. And then we may have that conversation if it fits. Sometimes it doesn't fit, sometimes it fits great. Sometimes they can increase their cash flow by coming over. Sometimes it doesn't. And, we'll be honest and open with them and tell them it's probably not worth it. So depends on the situation, depends on what asset it is.
Right. That's really interesting. One of the things we talked about off air was that you guys are in the middle of a big marketing push. Sounds like you guys have done a lot of deals. You've done a lot of different asset classes. You got a lot of experience under your belt. What does that mean? A big marketing push? Well,
for us, that means starting marketing. We've never done anything. I think this is like my third podcast or in like the 8 years we've been in existence. So, we're just trying to get the word out now. It started off as friends and family. I told you, me and my partner, we're on surveillance and came up with this idea of, what builds wealth and why are we sitting in the car, eating pizza and using porta potties as the restroom. But, real estate is obviously a huge wealth builder, and we kind of wanted to bring it to our friends and our family. And that's how we started. So we've grown just by word of mouth. But now, we're looking outside for, more accredited investors that are like our plan and want to get involved.
That's really, really cool. When you rewind the last 8 or 9 years you guys have been in business, what's one thing you feel like you've done really well that other people should emulate?
We take care of our investors, but that's a cop-out answer. I think we concentrate on really the assets and protecting our investor capital. And that kind of led us to the whole fund approach, because when we were doing syndications, we had 3 or 4 of them going at one time. And, you might get one that's lagging behind the other 3. And that's where all your attention and effort's going to. And, we just sat back and reflected once we exited those, like, man, if we had them together, that would have been a really kick-ass, fund. So that's kind of where the whole idea came from. It's protection of capital. Like, my grandmother's money is in our fund, so last thing I want to do is lose that. So that's our focus, is protection of capital. I think we do that better than most.
That's awesome. I absolutely love it. Keith, thank you for taking the time to come on the show today. Break down for us where you see opportunity, and, spending a lot of time telling us about how funds are structured, between closed-end funds and open-end funds, and the nuances to opening and launching each of those respectively, the various asset classes you've been involved in, where you guys are currently finding opportunity, and then, one way to find success, and that was by taking care of your investors. So thank you again for taking the time to come on the show today. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
They can just go to our website, and the number's there, our emails are there. It's dualcityinvestments.com.
Dual City Investments. We'll make sure we put that in the show notes.
Thanks for having me, Sam. I enjoyed it.
Absolutely, Keith. Thank you for coming on. Do appreciate your time today.
All right. Appreciate it. Thanks.